Hey everyone, welcome back to the channel. Today we're discussing active versus passive investing and whether skill can really beat the market. This is based on an article that explores the key differences, strengths, and challenges of each approach. Let's break it down step by step. Many people think investing success comes from skill. Better research, quicker decisions, and smarter choices leading to bigger returns. This idea supports a huge industry of fund managers and analysts. But there is another way. Passive investing, where you don't try to beat the market, but just match it by holding a mix of assets that follow broad indexes. Over the last 20 years, passive strategies have grown a lot and now hold a big part of global stocks. This debate isn't just about who wins, it's about how information works, costs, motivations, and how people act. Knowing it helps explain why outdoing the market is uncommon, why passive investing is expanding, and why active investing sticks around despite uneven results. So what is active investing? It's when you try to do better than a benchmark like a stock index. You choose which assets to buy, how much, and when to change based on your analysis or predictions. It assumes markets aren't always perfect. Prices can stray from true value due to missing info, emotions, or other issues. Active investors look for and use those gaps through study and decisions. This is common in mutual funds, hedge funds, and big money managers. But regular people do it too with frequent trades or picking stocks. Now, the strengths and limits of active investing. The big plus is flexibility. You can react to news, cut back on overpriced areas, and shift as things change. In theory, this lets skilled people handle risks better and grab chances passive can't. It's seen as helpful in tough markets when assets move alike and spreading out doesn't protect as much. Picking carefully might limit losses. But there are downsides, of course. It's costly. Fees, trading expenses, and taxes cut into returns and they add up over time. Competition is fierce. Markets are full of pros with the same tools and data, so lasting edges are hard. Studies show some outperform short-term, but few do long-term after costs. Next, what is passive investing? It sees markets differently. Prices mostly show what's known, so you don't hunt misprices. The goal is to get the market's overall return. This means following indexes with funds or ETFs that trade little and spread risk instead of choosing winners. Passive has grown due to low fees, clear holdings, and easy access. You know what you own, pay little, and get wide coverage with one buy. The key benefit is efficiency. Low costs keep more returns, spreading out cuts specific risks, and less trading avoids errors like selling in fear or overbuying. Over long times, this has worked well. Data shows indexes beat most active funds over a year, but limits exist. You're fully in for market drops and can't skip overpriced parts in the index. Still, active often doesn't dodge losses either due to fees and bad timing, so passive can still do better relatively, even with big absolute fails. Passive assumes markets stay workable, which might not hold in crisis. As it grows, some worry about focus in few companies affecting prices, but proof is mixed. Why is beating the market so hard though? All investors make the market together. Active ones own it all, so their average return before costs matches the market. Some win, some lose, but even out. At costs, and average active returns fall below. Passive skips most costs, keeping closer to market gains. Skill exists, some are better, but spotting them ahead is tough. And fees make benefiting harder. Now, people think active is always risky, but many focus on controlling risks, not wild bets. Another is passive is safe. No, it faces market ups and downs with big potential drops. The real split is judgment and timing for active versus spreading, low costs, and sticking to it for passive. Look at big events. Index investing has held up through crises like the dot-com bust 2008 and COVID. Over 15 years, most active US stock funds lagged the index after fees. Active should shine in crisis, but in 2008, most US active funds fell behind benchmark, over half for large stocks, more for smaller. Same in COVID volatility, most underperformed over the full period. This shows active can work sometimes, but consistency is rare and timing sensitive. Now, in conclusion, for most Passive is practical, low costs, clear, and fits long-term goals. Active persists because markets aren't perfect and some want adaptability or better results. But consistent wins need top skill, good setup and control, and even then, it's still uncommon. Knowing active versus passive shows why outdoing the market is tough, why simple often wins, and why results come from setup as much as smarts. And that's the overview on active and passive investing. What do you prefer, active or passive? Share in the comments, like if this was useful, and subscribe for more investing insights. See you next time.